The key question, I guess, is we've been telegraphing this, we've been expecting this, we're seeing a little bit of jitters in these Chinese markets. For the most part, do you think that this inflation risk has been priced in yet?
Well, good morning. We certainly think that we're going to continue to see some inflation price spikes over the next year or so. But until we start seeing a tightening of labour markets around the world, which of course we're seeing still very high levels of unemployment, there's no wages growth pressure. And it's really that's going to be the main driver of a sustainably higher level of inflation. Understandably so, through the pandemic, we've seen supply chain disruptions. So we're seeing inventory rebuild. A lot of the PPI number is obviously around commodity prices impacting China. And that gap between PPI and CPI is probably the largest we've seen for quite some time. But we don't see this just yet as permanent or sustainable. And so as a result of which, we're watching inflation very closely, but we're not overtly concerned in terms of seeing central banks change policy at this stage. It wouldn't surprise, however, to see Chinese authorities starting to jawbone, the impact of the higher PPI to try and see whether, in fact, they can just start to cool things down. But we don't think there's going to be major policy shifts just yet.
It sounds like you're kind of mapping out a bit of a Goldilocks environment, Martin, where the global recovery is moving along. It's not strong enough, though, to push policymakers to pull back on stimulus. So can risk assets still outperform then?
In this environment, the answer is definitely yes. But we shouldn't be afraid of corrections. We always see a number of corrections through most years. And so in the very short term, it wouldn't be surprising to see global markets have another correction. But we're talking about a very shallow correction, given exactly what you've just said. Conditions are very positively biased towards growth assets, particularly the share market, and as a result of which, the amount of cash that's sloshing around the world and looking for a home will continue to support growth assets. One of the caveats has to be that in the strong run we've seen this year, we've got to see a follow-through in earnings growth. So corporate earnings we are expecting to be reasonably strong. To give an example, here in Australia, we are expecting an earnings recovery to be the best since we've seen in the 1980s. But if that doesn't come through, then markets may be, to some extent, at some risk. But we are expecting to see reasonable earnings growth through this year. And overall, given the conditions, we are expecting global markets to be higher by the end of this year.
OK, Martin, that takes us, so that's the top line, of course, on the earnings expectations, and it takes us back to the input prices, the commodity price inflation that we're seeing, and the question of margins and whether or not you are now distinguishing between sectors where the margins may be squeezed as a result of these commodity pressures, or are you able to take a broader view?
Well, we can take both, to be quite honest with you, because when we look at or split down the commodities sector, you've both got the cyclical impact, so you've got rising demand, imbalances in global trade, and so inventory rebuild taking place, and that's been reflective on better commodity prices. When we look at structurally, however, things like commodities such as iron ore, clearly it's being impacted by the weaker production out of Brazil. And until that gets corrected in 12 or 18 or 24 months' time, you're going to continue to see the underlying demand for iron ore continue to support the pricing at this stage. So actually what we've got to be looking at is not just the broad brush commodities complex, but be looking at each individual commodities and look at the dynamics of each.
OK, and one individual commodity that's been in focus, of course, you've seen gold looking overbought in May. It's come off that now. The RSI is back to around 60. Do you accumulate gold at this point?
Yeah, for the first time in quite a while, we're getting a little more positive about gold, both in terms of a potential of a weakening or a sustainably weaker US dollar, given the proposed plans by the Biden administration in terms of their big infrastructure and fiscal spend. Certainly, if inflation is in the headlines, we're watching that closely, as we mentioned before. So that's an issue that will support the gold price. And then of course, we've got the fairly significant sustainable geopolitical impacts. That's probably going to support the gold price as well. So we're definitely accumulating gold exposures at this stage as an inflation hedge. And also, there's been a bigger push in terms of asset allocation across portfolios to have bigger exposures to alternative asset classes, of which gold and infrastructure, as an example, sits in that category for us as well.
And Martin, you mentioned the geopolitics. We are seeing these U.S.-China tensions intensifying. We have this China bill that just passed in the U.S. Senate. I think most people last year thought that a Biden administration would be more of a conciliatory administration towards China. It seems like we're seeing something that's a little bit more a continuation than a conciliatory tone. Do you think this is a big tail risk for markets?
Yeah, it's certainly one of the risks, without a doubt. I mean, the other risks, obviously, out of geopolitical is the flare-ups on COVID and the pace and rate of vaccinations. But given what China seems to be attacking on a number of fronts, or attacking is probably the wrong word, but certainly being more active across Europe, we're feeling it here in Australia. We're clearly now seeing a pushback, and it'll be interesting to see what the commentary out of the G7 is going to be. Let's hope that diplomacy on both sides starts to really play a more important role in regards to these tensions.